Imagine waking up and finding out that a boring corporate software company, a place that literally builds enterprise analytics and spreadsheets, has just secretly mutated into this $31 billion financial dragon.
Yeah, hoarding more Bitcoin than entire sovereign nations, which is wild to think about.
It really is. I mean, for a long time, when you thought of cryptocurrency, you probably pictured those early days, right?
Right, the underground anti-establishment rebellion.
Exactly. A bunch of coders trying to build a financial system that's completely outside the control of banks and governments.
But today, I mean, we're in 2026 now, and that original rebel alliance has collided headfirst with Wall Street.
Oh, yeah. Wall Street, complex corporate tax laws, and even artificial intelligence.
Which is a fundamental rewiring of modern finance and tech. The original vision was, a peer-to-peer electronic cash system.
Right.
But the reality unfolding right now is just far more complex. It's highly institutionalized.
And that is exactly why we are taking you on a deep dive into this whole transformation today. We've pulled together a massive stack of sources to figure out what is actually happening beneath the surface here.
Yeah, the goal is to cut through all the social media hype and just look at the raw mechanics.
Right, so we are diving into MicroStrategy's official SEC 10K filing, plus the 2026 market outlook reports from Coinbase and Messari.
We also have a highly critical paper on decentralized finance from the Bank for International Settlements.
Yes, and we're tracking real-time on-chain data from Glassnode. Our mission is to basically show you how digital assets are quietly restructuring corporate balance sheets and really the physical infrastructure of the internet.
Because it's moved way beyond surface-level price action at this point.
Totally. So let's start with the most extreme example of this institutional takeover, which is MicroStrategy.
Right, the software company.
Yeah, I mean, like I mentioned, they started as an enterprise analytics company. They even have an AI assistant called Otto.
Yeah, but if you actually read their 10K filing, they have completely rebranded.
Oh, completely. They are now officially billing themselves as the world's first and largest Bitcoin treasury company.
Which is a massive shift. I mean, as of early 2025, they hold nearly 500,000 Bitcoin.
500,000.
Yeah. And at the time they filed this report, that stockpile was valued at over $31 billion.
$31 billion. That's just, they are literally a tech company that morphed into a dragon hoarding digital gold in some corporate cave.
Basically, yeah.
But they didn't just, use the profits from selling their software to buy all that, did they?
Oh, no, not at all. They acquired the vast majority of it by aggressively issuing debt and equity.
Wow.
Yeah, they are borrowing traditional fiat currency, issuing convertible senior notes to investors, and then instantly converting those proceeds into Bitcoin.
That is aggressive.
It is. And this strategy is currently crashing violently into traditional accounting and tax laws, specifically because of this new accounting rule called ASU 2023-08.
Okay, let me make sure I understand the after here. Because prior to this rule, the accounting for crypto was essentially like a financial ratchet, right?
Yeah, the gears only turned one way.
Right. So if the price of Bitcoin dropped, your company's value took a massive hit on the balance sheet. But if the price skyrocketed, you couldn't show a single dime of that profit on your books.
Exactly, not until you actually sold the asset. And that ratchet effect made corporate adoption incredibly punishing.
Makes sense.
But ASU 2023-08 completely dismantled that mechanism. Now, corporations actually have to mark their crypto holdings to fair market value on their balance sheet.
Oh, wow. So the continuous price fluctuations, like both the gains and the losses, they now flow directly through their net income reporting.
Right, straight through.
And because Bitcoin's price surged recently, that triggered a massive ripple effect for MicroStrategy. I was looking at their filing, and adopting this new rule resulted in an instant $12.7 billion jump in their retained earnings.
Yeah, just overnight.
Just boom. $12.7 billion of wealth appearing on the books. But wait, I really need to push back on the strategy for a second.
Go for it.
Isn't it incredibly dangerous to borrow traditional money to buy a highly volatile asset, especially when these paper gains start interacting with the IRS?
It is incredibly dangerous.
I mean, they haven't sold the Bitcoin, so they haven't realized those profits.
And that is the exact tension hidden inside their 10K filing. Because under the U.S. Inflation Reduction Act of 2022, there is a corporate alternative minimum tax.
That's CAMT.
Right, the CAMT, which is set at 15%. And this tax kicks in for massive corporations whose average annual adjusted financial statement income over a 3-year period exceeds $1 billion.
Oh, I see where this is going.
Yeah, because MicroStrategy has to systematically allocate that massive $12.7 billion accounting adjustment from 2025 through 2028. Their on-paper income just
They
explodes.
suddenly crossed that billion-dollar threshold.
Exactly.
Which means they could suddenly owe actual physical cash to the IRS for wealth that only exists on a spreadsheet.
Right, paper wealth.
Where does a software company get the cash to pay a 15% tax on billions of dollars of theoretical wealth?
Well, if their software operations don't generate enough physical cash to cover those new tax liabilities, plus the interest on their massive debt, their options are severely limited.
And they have to go back to the market to raise more capital.
Yeah, but if the broader financial market turns against them and liquidity dries up, they might be forced to actually sell their Bitcoin just to pay their tax bills.
Wow. And flooding the market with that much Bitcoin would aggressively depress the price.
Which then lowers the value of the remaining treasury, yeah. It's a perfect illustration of how novel digital assets are introducing entirely new, unprecedented strategic risks to corporate treasuries.
That's fascinating. And MicroStrategy's massive accumulation isn't happening in a vacuum either.
Definitely not.
I mean, when one company pulls $31 billion in Bitcoin off the table, it triggers a chain reaction in the actual physical supply available to the rest of the market. I was looking at the Glassnode data we pulled, and it shows that nearly 45,000 Bitcoin were completely removed from exchange wallets in just a single 30-day window.
Yeah, the data there reveals a really profound structural shift. We're moving from retail trading to institutional hoarding.
Right.
Because when everyday retail investors buy crypto, they typically just leave it sitting in their account on the public exchange. But when an institution buys billions of dollars worth, the protocol changes entirely.
They pull those assets off the public exchanges.
Exactly. They transfer them into the custody of highly specialized institutional-grade security firms.
But so, if all this supply is draining from the exchanges, where is it physically going?
Well, into cold storage.
Right, but honestly, doesn't relying on massive, centralized custodians defeat the entire peer-to-peer purpose of cryptocurrency?
It's a huge paradox, yes.
I mean, if I wanted a massive institution holding all the keys to my money, I'd just use a traditional bank.
Well, these institutions require strict security protocols, right? The cold storage. The digital private keys that control the Bitcoin are generated and kept completely offline.
Like on physical hardware.
Yeah, often on physical hardware locked in geographic vaults to ensure they just cannot be accessed by hackers over the internet.
Okay, that sounds secure, but
But by concentrating billions of dollars of Bitcoin in the hands of a very small number of US-based, highly regulated custodians, the ecosystem introduces massive single points of failure.
right, because if one of these major custodians faces a catastrophic hack or even an internal failure,
Or severe regulatory freezing, yeah. A huge portion of the global crypto market is instantly paralyzed. It is basically the definition of counterparty risk.
and that structural contradiction, claiming to be a decentralized system while actually building these massive centralized choke points, that brings us directly to the research paper we have from the Bank for International Settlements.
Right, the BIS paper.
Yeah, the BIS takes this concept and applies it to the wider crypto ecosystem, and they call it the Decentralization Illusion.
And it is a rigorous, highly critical teardown of decentralized finance, or DeFi.
Because DeFi platforms market themselves as a way to trade, lend, and borrow money completely automatically through code.
Yeah, using smart contracts without any human middleman. But the BIS argues that true absolute decentralization is mathematically and practically impossible.
Because of what they call algorithm incompleteness.
Exactly.
Meaning you simply can't code a software solution for every single human emergency or panic that might happen in the real world.
Right. You cannot write a smart contract capable of perfectly anticipating every future market crash or every hidden software bug.
Or every unprecedented economic shock.
Yeah. And when the system inevitably encounters a scenario the original code didn't account for, human intervention becomes mandatory to save the platform.
Somebody has to step in.
Right. Decisions have to be made about how to upgrade the code or pause the system. And DeFi platforms handle this through governance tokens.
Which grant the holders the right to vote on these emergency changes.
Exactly.
But I'm looking at the data in this BIS paper, and the people holding all the voting power, they aren't the everyday users.
No, not at all. The distribution data proves that a massive majority of these governance tokens are allocated long before the public ever sees them.
So they go to internal developers, founders.
Early venture capital investors, yeah. the whales.
So the new boss is essentially the exact same as the old boss, just wearing a different technological disguise.
Pretty much.
We just reinvented Wall Street, but gave the power brokers digital avatars instead of corner offices.
That's a great way to put it. And the illusion of decentralization masks deep structural vulnerabilities. Because in traditional finance, when a massive panic hits, you have central banks and large commercial banks that act as systemic shock absorbers.
Right, they can instantly inject liquidity into the market.
Or halt trading entirely to stop a death spiral. But in DeFi, there are no shock absorbers. The entire system is built on private backstops.
Specifically, aggressive over-collateralization.
Yes.
Which leads to extreme fragility. Because if the value of the collateral a user put up suddenly drops, the smart contracts don't call you on the phone to negotiate.
No, they don't care.
They automatically trigger merciless liquidations.
Yeah.
No one is sitting there saying, hey, let's give the market a minute to breathe.
Right. The code just aggressively sells off assets to cover the loans.
Which drives the market price down further, which then triggers a fresh wave of liquidations, something like a localized financial contagion.
Exactly.
But, I mean, if the structural risks are this high, and there are zero shock absorbers to protect you, why would anyone risk using DeFi?
Well, the absolute lack of traditional friction and regulatory oversight allows for extreme, unprecedented financial engineering.
Okay.
The BIS points to the flash loan as the ultimate example. It is a financial instrument that simply defies the physics of traditional finance.
Right, the flash loan.
Yeah, a flash loan allows a user to borrow tens of millions of dollars without putting up a single penny of collateral.
Okay, stop. I need to understand the mechanics here. I borrow $50 million, I don't put up any collateral, and there's no credit check.
None.
How does the lender guarantee they get their money back?
The code itself is the absolute guarantee. The entire life cycle of the loan, the borrowing of the funds, the execution of a complex arbitrage trade across multiple platforms, and the repayment of the original loan, plus a small fee, all of that, must occur within a single block on the blockchain.
Wow. So we are talking about a massive transaction that exists for zero duration.
Exactly. If your underlying trade does not generate enough profit to instantly repay the $50 million within that exact same fraction of a second, the smart contract simply cancels the entire operation.
It just reverts the blockchain state as if the loan never happened.
Yep, like it never happened.
That is mind-bending. It's like robbing a bank, investing the stolen money in the stock market, making a profit, and returning the original cash to the vault before the door even finishes swinging shut.
That is a perfect analogy. And while it is virtually risk-free for the lender, malicious actors frequently use flash loans to temporarily borrow massive amounts of capital to overpower and exploit vulnerabilities in smaller DeFi platforms.
So they just drain them of funds?
Exactly. And this predatory environment is further highlighted by how everyday trading works in DeFi, using automated market makers, or AMMs.
Right.
Instead of a traditional order book where a human buyer and a human seller agree on a price, an AMM uses a mathematical formula to automatically dictate the price based on the ratio of different tokens sitting in a liquidity pool.
Okay, so, I mean, think of an automated market maker.
Mm-hmm.
Like a massive seesaw with apples on one side and dollars on the other, right?
Sure.
If someone takes a massive amount of apples off the seesaw, the price of the remaining apples naturally skyrockets to keep the underlying math perfectly balanced.
Yes, and that mechanism creates a massive vulnerability known as front-running.
How so?
Because all incoming transactions sit in a public digital waiting room, the memory pool, before they are officially processed into a block. So the network validators who confirm the blocks can see your trade before it actually happens.
Oh, wow.
Yeah, if they see you are about to buy a massive amount of apples, which will tip the seesaw and drive the price up, a validator can instantly insert their own buy order right before yours and then a sell order right after yours.
So they essentially grab the apples first, artificially inflate the price you pay when your order goes through a millisecond later, and then pocket the difference.
Yes.
That is totally predatory. I mean, in traditional finance, that kind of front-running would result in severe regulatory penalties and jail time.
Oh, absolutely. But here, it's just considered a feature of the code called minor extractable value, or MEV.
Unbelievable.
But the vulnerabilities outlined by the BIS, the predatory front-running, the flash loan exploits, the lack of shock absorbers, they basically force a critical evolution.
Right, because if we pivot to the 2026 Outlook reports from Coinbase and Messari, we see that the crypto industry didn't just collapse under the weight of these flaws.
No, it realized that pure anti-establishment rebellion simply doesn't scale to a global level.
So to survive, the industry in 2026 is rapidly integrating with the very systems it originally tried to destroy.
Exactly.
The Coinbase report talks about tokenization moving from a theoretical experiment to actual foundational utility. We are seeing massive traditional asset managers like BlackRock putting their institutional funds directly on public blockchains.
And BlackRock isn't doing this for the narrative. Putting a traditional financial asset on a blockchain allows them to settle complex trades instantly, 24 hours a day, 7 days a week.
Right, the efficiency.
Yeah, and more importantly, they can build programmable compliance directly into the token itself. So they ensure the asset can only be traded between verified, legally compliant entities without needing a massive back office team to manually check every transaction.
And the backbone making all this traditional integration possible is the stablecoin.
Yes, stablecoins are huge.
The Coinbase stochastic model projects that the total market cap for stablecoins, these digital assets hard pegged to the US dollar, could reach $1.2 trillion by the end of 2028.
Which shows they have completely decoupled from speculative trading. They are now the underlying utility-powering global cross-border remittances.
And international payroll platforms.
Exactly. But the evolution documented by Messari reveals that the integration extends far beyond just traditional finance.
Oh, definitely.
The industry is currently building the physical architecture of the future internet through DePIN.
Right, decentralized physical infrastructure networks.
Exactly. Instead of relying on a centralized mega corporation like AT&T or Amazon Web Services to build cell towers and data centers, DePIN uses token incentives to crowdsource physical infrastructure.
It's essentially an Airbnb model, right?
Yeah.
But instead of renting out your spare bedroom to a tourist, you're renting out your computer's spare brain power to the network.
That's a perfect way to explain it.
The Messari report details how networks like Helium allow a regular person to buy a specialized router, stick it in their apartment window, and provide actual telecom coverage to their neighborhood.
And in exchange for providing that physical service, the network automatically pays them in crypto tokens.
Their Filecoin, which pays users to offer up the excess unused storage space on their personal hard drives to host global data.
Right. You are watching the deployment of a global network of networks architecture completely funded and maintained by individual participants.
It's pretty amazing.
But the most futuristic trend outlined in these 2026 reports, and honestly, the one that will likely have the biggest impact on the broader economy, is the quiet collision between crypto protocols and artificial intelligence.
Oh, this part completely changes the definition of what cryptocurrency even is.
It really does.
We now have AI agents, sophisticated software programs designed to act autonomously on our behalf to solve complex tasks. But AI agents face a massive structural roadblock.
Right. They don't have human identities.
Exactly. They don't have social security numbers, they can't open a checking account at a local bank, and they certainly can't sign up for a corporate credit card.
Right. So if an autonomous AI agent is trying to solve a problem and it urgently needs to purchase a specialized data set or rent a fraction of a GPU on a decentralized compute network like Akash to process an algorithm, it requires a way to execute that payment instantly.
It cannot wait 3 business days for a human to approve a wire transfer.
No, it can't.
Wait, so crypto isn't just about humans trading coins on an exchange anymore. It is quite literally becoming the native currency for software programs to pay each other in real time.
Exactly. The blockchain provides the open, permissionless rails for machine-to-machine commerce.
Wow.
Protocols like BUY-402 are enabling these agentic AI systems to autonomously settle high-frequency microtransactions. An AI can locate the data it needs, negotiate a price with another machine, execute a smart contract, and settle the payment using a stablecoin.
All in a fraction of a millisecond.
Yes. Crypto has quietly evolved into the foundational plumbing for global automated compute.
But with all these autonomous machines, complex smart contracts, and tokenized real-world assets zipping around at the speed of light, the risk surface for the average person is expanding exponentially.
It's massive.
And the Messari report actually points out a fascinating counter-trend to all this complexity. Because the counterparty risks are so high, users are aggressively returning to self-custody hardware wallets like OneKey to interact safely with this new web.
Which is the most rational response to an incredibly complex environment.
Yeah, I mean, when you are interacting with automated market makers and AI agents, you cannot blindly trust a centralized platform.
Right. Hardware wallets provide a necessary physical layer of verifiable security. They ensure that the user maintains absolute cryptographic control over their assets and their digital identity.
It's like a return to the original cypherpunk ethos of self-sovereignty.
Exactly. But it is being applied to a vastly more sophisticated and institutionalized ecosystem.
Okay, let's take a breath and bring this all home. We have journeyed through an incredible amount of complexity today.
We really have.
We started by looking at how MicroStrategy utilized aggressive debt to mutate into a $31 billion Bitcoin dragon, and how that strategy trapped them in a bizarre collision with the corporate alternative minimum tax.
Yeah, that tax trap is wild.
And then we peeled back the curtain on the decentralization illusion to examine how DeFi is propped up by insider whales and how a lack of shock absorbers enables the predatory mechanics of flash loans and front-running.
Right, and we traced how the industry is maturing to survive those very vulnerabilities.
Moving away from speculative, narrative-driven trading.
Exactly, embedding itself deeply into the core of global finance through tokenized assets and trillion-dollar stablecoin projections. And at the same time, it is incentivizing everyday people to build the decentralized physical infrastructure of the future.
And you should care about this because cryptocurrency has fundamentally outgrown its original identity. The chessboard is completely changing under our feet right now.
It really is.
This isn't just internet money used by early adopters anymore. It is rapidly becoming the new automated back-end infrastructure for global finance, telecommunications, and the AI economy.
Which leaves us with one final thought to ponder.
All right, what is it?
If these autonomous software programs are increasingly using stablecoins to execute millions of microtransactions a second, generating their own internal profits, and operating 24 hours a day without ever sleeping,
Yeah.
how long is it until a non-human entity accidentally becomes the wealthiest participant on the blockchain?
Wow. That is exactly the kind of thought that forces you to reevaluate everything we just discussed. And on that note, that wraps up our mission for today. Thank you so much for joining us on this deep dive, and we'll catch you on the next one.